Now that we turn to Asia, we're going to look at some key factors, especially when we talk about China and some of the India and South Korea. We really want to look at imports, exports. Now, there's other data points which we'll talk about later on, but again, imports and exports is going to be the focus that we're going to discuss with you in terms of what's happening. So the big thing that is being talked about when we look to China is the amount of exports. So exports rebounded they were up 9.5%. Things were looking better, but again, we continue to look at overall. So when we look at overall and we do our own ship tracking, again, those exports seem a bit lofty. It could be something that was just a timing delay. It could be something that we may have had factored in a different month. But again, that 9.5 seems a little bit off. But the imports don't. The imports were down 2.1% year over year. And the imports is a bigger problem for us when we think about the future of the overall output. So when you think about China, China imports a lot of raw materials, a lot of semi-finished goods, and then they export a lot of semi-finished products and a lot of finished products. So you have to consider that as imports go down, exports are going to struggle as well, because when you think about the assembly, the manufacturing, there should be a certain amount, and that's going to go from the imports into the export market. Now, again, there's always going to be that timing lag, but the other key factor that we have to look at is what is the local consumer doing? And the local consumer continues to struggle. We've seen that with consumer spending. We've seen that with inherent driving that isn't for work. We've seen that just overall for the local consumer, especially with unemployment being elevated in China itself. These are things that are going to weigh in terms of on when the Chinese economy recovers, but also when we look at where are their exports going? What are their trade partners doing? We've seen them. We've talked about many, many times about their fight with India, about the trade war with the U.S. These are things that are going to continue to weigh on the total exports as you have more and more friction, specifically in Southeast Asia, which is something that we're going to cover in a separate segment. Now, when we look at the internal China analytics, we have to look at, okay, well, what's important to really look at? And that's when we want to look at, okay, well, what are the reserves? What are gold reserves? We've seen that they've increased over time, using that to try to backstop some of their debt, some of their issuance. The other big thing is going to be that external debt. So when we look at external debt and we're going to price it in US dollars, you can see the debt levels have only increased. And even though this chart doesn't pick up overall just because the new data hasn't been released, we know that it's continued to increase as corporations and the sovereign nation have gone to the debt market again to increase that debt level to take in some of those additional dollars. Now, the China foreign exchange reserves, you see, that even though they've had a fairly healthy, just given more exports versus imports, they've had a nice trade balance, which means that they should have more dollars or more euros or more foreign reserves sitting on their balance sheet. So here you can see the foreign reserves have fallen, but now you have another interesting dynamic starting to take shape. And the comment is now typically they own about $1.1 trillion worth of U.S. treasuries. They have announced, or at least hinted at, that they're going to sell down about 20%, putting them at about 800 to 860 billion away from their normal 1.1, 1.2 trillion. Now, the reason why that's so important, it's not so much that they're trying to get back at the U.S. for something, because again, putting those treasuries and just trying to flood the market with treasuries would only hurt their price, and it would be mutual destruction if you think about that. Or the Fed would just show up and just buy them all. So really, what kind of pain would you create? The bigger issue is, why is China doing this? If you think about how bonds work, right? So you get the principal, you have the interest expense. So when China is taking delivery of interest payments, so they are naturally taking in dollars by taking delivery of these interest payments. Why sell? And this is when we start to look at, because they need the cash now. They need to pull those dollars in. They need to liquidate because they need that principal back. They need to bring and pull that money forward because they have an issue in terms of leverage, in terms of just getting some of these foreign reserves to prop themselves up, which is a bigger problem as we start to see this dynamic at work, which is why we continue to look at this and why we want to really hone in on, well, China foreign exchange reserves, where do they sit? And you could start to see they've increased a little bit. Coming back down to the benefit of higher exports than imports. But again, this creep is going to be a bigger problem because they continue to issue debt. And as they continue to issue debt, they also have an increase in non-performing loans. So if you have more non-performing loans, you need more capital left on the balance sheet, which again comes back down to a foreign reserve shortfall, which is why they're pulling some of these dollars forward, which is an inherent problem with their overall economy, which is why believing them is a little hard right now when you think about their fact that they're going to be growing at this point. Now, non-performing loans are on the rise. We've been talking about this extensively. We've been talking about it from the perspective of special purpose bonds, state-owned enterprises, private. This is going to be a bigger problem because if they're admitting to these non-performing loans, how many of them sit in the wings? How many of them are sitting around? And when we look at Lao and you look at the fact that they've taken delivery of the electrical system, or at least parts of the electrical grid that they built under the Belt and Road Initiative, coming back full circle to debt diplomacy, we've seen that these are debt payments that they've taken the asset, but the revenues continue to fall well short of where they should be. And non-performing loans need a bad debt expense. It has an offsetting side, which is why you need a higher foreign exchange, just to make sure that people don't get concerned about inflation, because then that would create its own problem overall. Now, while we've seen non-performing loans increase, we've seen all these issues, loan growth continues to rise. Now, this is a big problem when you think about an already stressed balance sheet, or already having issues in the export market, seeing imports fall as the local consumer struggles, seeing flooding in the Yangtze River. It's all being financed with more and more debt. And this is going to be a problem. Now, this obviously goes through June. We know just based on headlines and data that's come out, this has only gone up through July and August. And there's really no way that this is going to slow based on how they're trying to prop up the economy. They're trying to get cash, through the system. And the PBOC is really dictating of you need to lend, you need to either take a haircut on the total interest, you need to delay interest payments, you need to do something to give some of these companies the ability to delay and to try to take some of this pain away from them to allow them to get to the other side. Again, these are the issues that continue to rise. And then when we shift to South Korea, you can see South Korea exports, imports, something very similar. Exports have come back. Again, the exports were a little bit better than expectations. They are only down 9.9%. The expectation was for about 11%. And with imports, the imports were surprised to the downside, and they were down 16.3%. Again, these things continue to be an overall problem. And that's why when we look at South Korea, we look at Germany, we look at China, we look at India, these are great bellwethers for the economy, and they continue to struggle. So when we look at South Korea, they have something very similar. They're exporting finished products. They're exporting final products. And we're seeing those struggle because imports are down. So the local consumer is struggling. Imports for these entities struggle. And then the question is going to be, what is going to happen with South Korea and China in terms of, some of these growing tensions that remain in the area. Samsung and has already come out and said that in relation to the new U.S. sanctions on Chinese companies, they're going to adjust. They're not going to sell, whether it be microchips, motherboards, some finished or semi-finished goods to China. Again, this is only going to increase the tension because South Korea is going to take the side of the U.S., which is going to be a bigger problem as we look at Asia. So that's about it for this segment. We just want to talk really about trade, what's happening in the trade world, and how it relates. Because if you remember back to the very beginning, we talked about falling U.S. imports, and again, it's showing up in all of these little areas, which is why it's just a better way to view the overall growth. Because all the way back at the beginning, when we talked about the economic indicators, the daily indicators, we already saw a lot of these slowing down and or flattening out, which again already points to the problems within these countries. And you can see that just based on the trend of the exports, the trend of the imports, it doesn't look like it's going to be adjusting anytime soon as we kind of flatten out and now head to the right without much growth coming.